Hello, welcome to Pathfinder Wealth Consulting's April 2025 Taxes and Politics presentation. This presentation is designed to be an update on how our new political landscape can shape tax policies, the economy, and the markets going forward. My name is Alex Greer. I'm an Associate Wealth Advisor with Pathfinder Wealth Consulting. I'm excited to run through the presentation today and hopefully cover a number of key items and things that you've seen in the news recently. Our agenda for the day, we want to spend the first portion of the presentation talking about politics, specifically talking about the new administration and what many analysts are calling Trump 2.0. We'll talk about some of the key policies that have been introduced and some other key items that are planned to be introduced in the future. We'll also spend some time talking about Congress and where we stand there before diving into tariffs. I want to make sure that we don't just talk about the new tariffs that have been put into place, but also talk about tariffs on a larger scale and why countries may use them. We'll then spend some time talking about the markets and economy and the recent volatility that's been experienced. We'll spend some time also going through economic indicators and where we stand currently before we start to get new reporting data after those tariffs have been put in place. We'll then finish up the presentation talking about taxes, specifically the Tax Cuts and Jobs Act, which is set to sunset at the end of 2025. We'll talk about what it'll look like if it does sunset or expire at the end of the year, and then some other tax proposals that have been floated under the current administration. I know some of the things that we're going to talk about today might stir up some politically induced emotions. Everyone is entitled to their own opinion, and the purpose of this talk is not to debate over which party is better, but rather cover the impacts of the current administration's policies on the current and future state of the markets and economy. With that said, we'll go ahead and jump into the politics part of the presentation and really talk about the second Trump administration, Trump 2.0 as many people are calling it. There's a number of key things that the Trump administration has prioritized early in its tenure. I want to touch on a number of those key items below. I will say we could probably spend an hour on this slide alone. This is just designed to be a quick statement on a number of different areas that the current administration has talked about in the past. On immigration, Trump has promised the largest deportation operation in U.S. history. He's promised tighter border security, mass deportations, and renewed construction of the southern border wall. On the economy, he plans to cut taxes further, reduce regulations, and pursue an America First trade agenda, including more tariffs on foreign goods. Looking at the government overhaul, which we've already seen starting to come into play, he's proposed expanding presidential power significantly. He's also talked about limiting the independence of federal agencies and making it easier to fire large numbers of government workers. This is where the Department of Governmental Efficiency has come into play. On the foreign policy side of things, Trump has advocated for a tougher stance on China, ending U.S. involvement in forever wars, and reducing American aid to foreign countries unless it directly serves U.S. interests. On the justice system, he's called for retribution against political opponents and greater control over the Department of Justice and the FBI, both of which he says are corrupt. In culture and society, Trump has really positioned himself and continued to position himself as a defender of traditional American values while pushing back against what he sees as woke culture in education, business, and government. He considers himself a departure from the previous administration. On the energy side of things, this is also a departure from the Biden administration. Trump supports an expansion of oil and gas and coal production, and he also supports rolling back Biden-era climate policies. There were a number of new green climate policies passed in the Inflation Reduction Act, which Trump has talked about trying to repeal. On the healthcare side of things, he seeks to repeal and replace the Affordable Care Act, also known as ACA or Obamacare. He has not detailed a specific replacement plan yet. So we'll keep our eyes on this and see what may be proposed as a replacement for the Affordable Care Act, but it is something that he has talked about redoing. Lastly, I want to talk about the military. Trump has emphasized rebuilding the military, focusing on modernization and then having a tough stance on global adversaries. As I said earlier, we could go deeper into all of these subjects, but this just gives a big overview of what the Trump administration is prioritizing and what some of their plans are moving forward. Before we dive into those tariffs specifically, I do want to touch on Congress. Right now, the House and the Senate are both under Republican control. In the Senate, there are 53 Republicans, 45 Democrats, and 2 independents who caucus with the Democrats. In the House of Representatives, there are 218 Republicans, 215 Democrats, and then there are 2 vacancies. Although 2025 is not an election year, there are several special elections that are set to take place. One of which has already occurred, two of which have already occurred actually, in Florida's 1st and 6th congressional districts. Special elections were held on April 1st to replace former Representatives Matt Gaetz and Mike Waltz. Representatives Jimmy Patronis and Randy Fine won these seats, respectively, maintaining GOP control. Texas's 18th congressional district has a special election set for November 4th. This is following the death of Democratic Representative Sylvester Turner on March 5, 2025. This special election has drawn some criticism from the Democrats, who argue it leaves constituents unrepresented for an extended period of time. There's one more special election set for 2025 in Arizona's 7th congressional district. This election is planned to fill the vacancy left by Representative Raul Grijalva, who passed away on March 13th. The exact date of this election is yet to be announced. These are the only elections set so far for this year, but there could be other ones that come about. Obviously, midterm elections will occur in 2026. It is something to note that the president's party typically loses seats when the midterm elections come around. This is into next year, though, and doesn't have any immediate impact on what's going on. Now, for one of the main topics of today's presentation, I want to spend some time talking about tariffs and trade. This has certainly been in the news and is one of the key items that the Trump administration has highlighted as they've come into office. Before we talk specifically about what has been put into place recently, I do want to spend some time talking about what tariffs are at a larger level and then why some companies may use them. Simply put, a tariff is a tax imposed on one country on the goods and services that are imported from another country. Typically, when you hear the word tariff, you're hearing about an import tariff. Typically, these tariff costs are passed on to consumers in the form of higher prices. So an example of a tariff, let's say that I'm an automaker and I produce my cars in Mexico and then bring them to the United States for sale. The United States may put into place a 25% tariff on U.S. on automakers when they bring cars to the border. So the minute that I hit the border with my car that I've produced in Mexico, I have to pay a 25% tax on the value of that car. There's a number of reasons that countries may look to do this. It may be done to protect domestic industries. Certainly, if I produce my cars in Mexico and then I have an additional tax before I can bring them to market in the U.S., that's going to give a competitive advantage to some of the U.S. producers of automobiles. This can also be used to reduce trade deficits. We'll talk specifically on a later slide about the trade deficits that the U.S. runs, but simply put, a trade deficit exists when a country imports more from another country than they export to that country. An easy way to think about this, if we buy more from another country than we sell to that country, we're running at a trade deficit with that country. The other thing is that this is a source of government revenue. It's a tax and it goes directly to the government. So this can help the government meet its debt and make revenue and pay for the expenses that it has. These are just a handful of the reasons why tariffs may be used. Before talking further about the specific tariffs that we have, I want to talk a little bit about two opposite ideologies, which is really free trade and protectionism. Free trade is exactly what it sounds like. Goods and services move across borders without restriction and really let the markets decide. So if one country has a competitive advantage in producing a certain good, that country can focus on producing that good, and companies will move their production to that country to allow it to be produced in the most efficient manner possible. This can result in lower prices, more innovation, and better global cooperation as our supply chains become more intertwined. On the other end of the spectrum, you've got protectionism. This is typically where we see tariffs used. This can be an ideology that protects domestic industries from foreign competition, and it can be used to really build national strength. This can result in stronger local jobs and business and less dependence on other countries. This can also be used to provide safeguards on strategic industries. Things like oil and gas or defense manufacturing, a company may want to make sure that they are producing a strong amount of those in-house and not become reliant on other countries that they may be future adversaries with. Like anything, the truth is somewhere in the middle. The U.S. and the world as a whole has really moved towards a free trade economy since the end of World War II. However, the U.S. has utilized tariffs, even going back before this most recent round. In 2024, the average effective tariff rate was around 2.5% in the United States. So this is just, like I say, two opposite ideologies, and really sets the stage for different, trains of thought around trade. I do want to talk a little bit about trade imbalances. The U.S. is the biggest importer of goods and services in the world, which does lead to consistent trade deficits. The U.S. has run a trade deficit every year since 1975, so that's the last 50 years we've run a consistent trade deficit. The biggest contributors to our trade deficit are China, Mexico, and Vietnam. This probably isn't surprising to you. I'm sure if you look at your clothes or a number of items that you've got around the house, it's not uncommon to see made in China, made in Mexico, or made in Vietnam. So this sets the stage a little bit for what Trump is hoping to do with the tariffs that he's enacted, as he wants to level out some of these trade imbalances. Looking at what's actually taken place so far, on April 5th of 2025, a 10% baseline tariff was imposed across the board. This was on all industries and all countries on goods being imported into the United States. On April 9th, 2025, tariffs ranging from 11% to 74% were imposed on imports from 57 countries. It appears that these different rates were determined by trying to make up the trade deficit with that country. So the countries that we have a larger trade deficit with, we had larger tariffs imposed on them. It is important to note, and I'm sure many of you have seen, that there was a 90-day pause placed on a majority of these tariffs, as the Trump administration said that a number of countries have come to the negotiation table and are looking to make a trade deal. Because of this, the Trump administration put a pause on tariffs. There's one big exclusion to this, and that is tariffs on Chinese goods, which have been raised to 145%. Initially, tariffs of 104% were placed on China, and China immediately retaliated with 84% tariffs on U.S. imports to China. The U.S. then raised the tariff rate to 125% before ultimately landing at 145%. Now, it is difficult to determine the exact tariffs actually being paid on goods being imported from China because there are a number of carve-outs on specific products and industries that have been put into place. This is not unheard of, as actually in the first administration, Trump administration, when tariffs were placed on China, a great example of this was Apple. Apple and the tech industry received a carve-out, and so Apple was not affected by the tariffs placed on China at that time. It's to be determined where we go from here. There's been a lot of back and forth reported in the news between the United States and China, but right now those tariffs on China are still in effect. While it's too early to have good, hard economic data on what the initial impact of these tariffs has actually been, we can look at some of the potential impact of tariffs and things that have happened previously. Tariffs can lead to higher consumer prices. When companies have to pay the additional tax before bringing their product to market, it's likely that they're going to pass those extra prices on to consumers. With price increases, this can lead to inflation. If consumers absorb those price increases and continue to spend, it can lead to prices continuing to rise. Typically, when tariffs are introduced, it does lead to a spike in inflation that then normalizes over time. One thing I want to skip down to is potential lower GDP growth, because to have inflation, you do have to have increased spending. Coming off of the recent higher inflation that we saw over the past couple of years, it's possible that as higher prices reach consumers, they don't opt to spend the money. The consumer could decide that they're not going to buy as many goods and services, they're going to cut back. If that happened, it could lead to lower GDP growth, which could lead us to a recession. As we talked about with US and China, retaliation can happen when tariffs are put into place. A lot of times, if one country enacts tariffs, the country that has those tariffs placed on them will then place retaliatory tariffs on that initial country. Like I said, we've already seen this with the United States and China, and we'll continue to monitor that situation and any other potential trade wars that could pop up. There can also be some supply chain disruptions as companies look for different places to source parts for their products or different places to move their manufacturing. This can lead to a shortage of goods as supply chains get disrupted and things move around, which can be a strain on the consumer. You can also see reduced investment from companies. Typically before a company makes a large capital expenditure, they want to have certainty around policy. Tariffs can be unpredictable, and so it can cause companies to pause maybe investment that they had planned in a certain country or certain production methods. It can also cause them to wait and see how long the tariffs are going to be in place. Certainly, companies want to be strategic about how their supply chains are set up, And if they want to invest in new plants in different countries because of tariffs, they want to be sure that those tariffs are going to be in place for a long time. These are just some of the potential impact on tariffs. We'll continue to monitor as we get data to report what the initial impact has been on the tariffs that have been put in place. Before we move on, I do want to run through a quick example. Trump's new 25% tariff on imported auto parts are expected to lead to an increase of roughly $5,000 in extra costs per vehicle. So this is just one example of an industry that has a tariff on it and how that can impact the end consumer. Now that we've talked a little bit about the Trump 2.0 and the current administration and the tariffs that have been put in place, I do want to talk a little bit about the markets and economy. One of the big things that we've seen recently in the markets, especially over the month of April, is that volatility is back. This is a quote here: "If you're nervous about volatility, just wait a few days. It is typical to see big swings in either direction once volatility picks up." Before we talk more specifically about the volatility that we've seen, I do want to look at the major stock indices so far year to date. All three major US indices are down, led primarily by tech stocks. If you look here at the year-to-date returns, the S&P 500 is down 8.6% year-to-date as of close on April 23rd. The Dow Jones is down 6.9% as of close on April 23rd. And the NASDAQ Composite, which is the tech-heavy index, is down 13.48% as of that date. So certainly it hasn't been a good year for the major US indices starting out. You can see some of the volatility reflected in this chart with some big down days followed by big up days. Before we talk about that volatility in more detail, I also want to run through asset class returns year to date, because it's important to remember that while the three major US stock indices are down, there have been assets that have performed well year to date. Gold is the top performing asset class, followed by global and foreign stocks. Money has been flowing out of domestic stocks, which are US stocks, and then into foreign assets. Bonds have remained positive year to date as well. This is important to remember and really shows the importance of having a diversified portfolio. You want to have exposure to a number of different asset classes and a number of different markets because this can reduce your exposure to any one political event. Looking at the bottom of the year-to-date total return chart, you can see US small cap has been hit hardest so far year to date. This is due to small cap companies having a really difficult time absorbing disruptions in their supply chain and absorbing the additional costs that can become about because of tariffs. As you can see, US large cap growth is the next worst performer, and these are those tech stocks that we talked about earlier. Looking here at US GDP projections year to date, GDP was up 3.1% in Q3 2024 and was positive 2.4% for Q4 2024. For the calendar year of 2024, GDP was up 2.8%. As of the March meeting, the Fed projected 1.7% growth for 2025. This is down a little bit from where we were at the beginning of the year, and you can see a reflection here of how some of those projections have changed. GDP forecasts have plummeted, heightening recession fears. We're not at the point where we have new GDP data to actually look at after the tariffs have been put into place, but the projections have gone down sharply since then. Looking at the volatility specifically, I do think it's important to note that while many of the policies and things in the news are different, volatility itself has happened before and it's going to happen again. Looking at 2023 and 2024, those were years where there wasn't too much volatility in the market. The chart on the left here, this shows days in the market where the S&P 500 swung either greater than 2% or less than 2%. So you can see that in 2023 and 2024, we only had 8 total days with a greater than a 2% swing in the S&P 500. This chart is as of April 4th, 2025, and as of April 4th, we had 4 days that had a greater than a 2% swing up or down. Since April 4th, we've had 5 more plus or minus 2% trading days, bringing us to 9 so far on the year. If you look back farther than the previous 2 years, though, you can see that 2022 was a volatile year. In 2022, we actually had 46% of those 2% swings in trading days. It's also interesting to look at the fact that of those 46 days, 23 were 2% or more gain days, while 23 days were 2% or more down days. So it was an even split between up and down volatility days. Going back beyond 2022, in 2020, there were 44 days that met this volatility threshold. And then going back beyond that, 2018 was volatile. And then you can see a lot of heightened volatility around the 2008 and the Great Recession. Looking at the charts on the right here, this kind of shows us what stock market volatility can tell us about potential returns and economic growth. The first bar graph chart here, this shows average S&P 500 return. And the very first bar graph, the one that shows 0.3%, that's the average annual return for years where there are 10 or more of the 2% plus or minus trading days. So if we have those increased volatility years, typically the average annual S&P return is only 0.3%. On years where we have less than 10 of those 2% plus or minus trading days, the average annual S&P 500 return is 19.9%. US GDP growth follows a similar trend, with the more volatile years having an average annual GDP growth of 1.3%, while the less volatile years have an average annual GDP growth of 3%. These are a couple of great charts that can tell us about what volatility has meant in the past and what it could mean looking forward. As I said, when you see big down days in the market, it's not uncommon to then quickly see big up days in the market. The best days have typically followed the worst. This chart on the left shows 3 of the worst days since 1950. What you'll notice from all 3 of these days is they all occurred in March of 2020, right after COVID hit the United States. You can see that the second worst day since 1950, there was a 12% pullback in the market. On the third worst day, there was a 9.5% pullback, and then on the ninth worst day, there was a 7.6% pullback. What you see on the right-hand side is 5 of the best days since 1950. You can see that all 5 of those days also occurred in March 2020 or early April 2020, right after COVID hit the United States. So it's really, really important to think about the fact that, trying to time the market is not necessarily the best strategy, because reacting to a down day can lead you to miss out on really positive days in the market. Over the last 20 years, 24 of 25 of the best days in the market occurred within 1 month of one of the 25 worst days. It's also interesting to look at the return 1 year later, as that shows that just because one day is down significantly, that doesn't mean that your returns after that are also going to be down. Looking specifically at the second worst day since 1950, we were down 12% that day, but the return 1 year later, or the trailing 12-month return, was 69%. One more chart here, really just to show that staying invested is better than timing. This shows how missing those top performing days can hurt your overall return. So this is run from 2005 to 2024, and it shows an initial investment in the S&P 500 of $100,000. If you had placed money into the S&P 500 in 2005, that $100,000, by the end of 2024, it would have grown to $717,000. If you missed just the 5 best days in the market during that time period, the ending balance would have been $452,884. So being in cash just for those 5 best days would have greatly reduced the total value of your investment at the end of that time period. The more days that you miss, the lower that ending balance is. And if you'd missed the 25 best days, instead of having $717,000, you would have just $158,792. This is why having a diversified portfolio and riding out the ups and downs of the markets is the strategy that we typically recommend. It can be really, really difficult to time the market and get in and out at the correct times. Moving off of the volatility and talking about some of the economic data that we have, I want to start talking about inflation. These inflation numbers are certainly not reflective of those new tariffs that we talked about earlier, but I think it's good to have a baseline for where we're at currently. Inflation has come down significantly from its 2022 highs and has actually remained low. You can see this chart here running back to March of 2005, and really what I want to look at is on the right-hand side. You can see the spike in inflation, and then you can see where we've come down from that. Right now, inflation sits at about 2.4% for the trailing 12 months. Which is still above the Fed's 2% stated target. But I want to bring up a different number. In financial plans for clients, we use a 30-year moving historical average for inflation. Right now, that 30-year historical average is 2.67%. So at 2.4%, we're right in line with where we've been historically. I want to talk a little bit about interest rates as these go hand in hand with inflation. Looking at this chart, you can see how coming out of the Great Recession, we saw low federal funds effective rates and really stayed that way through the first half of last decade. Towards the latter half of that decade, we increased. You can see where rates went back down once COVID hit, and then they rapidly increased as the Fed tried to fight inflation in 2022. What you can see is that we did start to see some cuts. Last September, there was a 50 basis point cut. Last November, there was a 25 basis point cut. And then in December, there was another 25 basis point cut. So we're sitting right now at a Fed's fund effective rate just above 4.3%. The Fed and Fed Chairman Jerome Powell have indicated that they want to take a wait and see approach when it comes to inflation before deciding on any future interest rate cuts. It had been projected that we may see some interest rate cuts in the first quarter or first couple quarters of the year, but with the recent policies that have been introduced, it's unlikely that we see a cut at the next Fed meeting. Ultimately, the earliest that we would anticipate potentially seeing that next Fed cut would be sometime in the summer months. Depending on what the inflation data is and then other economic data stemming from these tariffs, we could see no cuts at all. We'll continue to monitor this to see what happens. I do want to talk quickly about the U.S. economy and the national debt. Higher debt levels are associated with slower growth, higher interest rates, and higher inflation. This chart here, I won't spend too much time on it, but this shows the federal debt, the total public debt as a percent of gross domestic product. This goes all the way back to the 1960s, and what you can see is that across parties, it has consistently risen over time. Right now, total U.S. debt as a percentage of GDP sits at just under 122%. This is a key thing that the current administration and future administrations have to consider when they're thinking about tax policy, as they have to think about where revenues are to meet and service this debt. This is also a reason that we've seen President Trump commenting on his desire for the Fed to cut rates. If rates are cut by the Fed, this will reduce the interest that the U.S. has to pay on its debt and make servicing that debt easier month over month. Another great economic indicator to look at is the U.S. Unemployment rate. Unemployment has remained low. You can see coming out of the Great Recession, throughout much of last decade, unemployment continued to go down. There was a spike in 2020. Again, that's when COVID hit. But you can see we're coming out of COVID relatively quickly. We normalized and got back and kind of leveled off. Right now, U.S. unemployment sits at 4.2%. One thing that is important to note, the federal government is the largest single U.S. employer. Over 8 million people are either directly employed or supported by federal contracts and grants. This makes up about 5% of the overall working population. So we'll continue to monitor what potential Fed cuts could look like when it comes to employees and the effect that that has on the unemployment rate. While we're looking at economic indicators, I want to talk a little bit about the U.S. consumer. Consumer sentiment plunged 11% this month, April of 2025, to a preliminary reading of 50.8, the University of Michigan reported. This is the second lowest reading on record going back to 1952. April's reading was lower than anything seen during the Great Recession. This is something that we'll continue to look at moving forward, as consumer sentiment was relatively positive before these recent developments. Outside of just polling, the other great way to look at how consumers are feeling is consumer spending. Early in the year, consumer spending had remained positive except for a quick retraction in January. March data will be released on April 30th, so in 2 to 3 months, we'll start to get spending data reflective of these tariffs that have been put into place. How the U.S. Consumer continues to spend is going to have a lot of impact on our GDP and ultimately, if we head into a recession or not. A couple last things to touch on here before we move into the tax portion of the presentation. I do want to touch on the U.S. dollar index. That's dropped 8% year to date. Gold year to date is up almost 24%. In addition to this, Treasury yields have stayed high despite the economic uncertainty. Usually, Treasury yields drop as money flows into them as a safe haven when uncertainty arises. You can see in this chart here that the U.S. dollar has lost its appeal and gold has skyrocketed. This isn't completely uncommon, especially gold increasing in periods of increased volatility. We see capital flow to gold when volatility arises, as it's considered somewhat of a safe haven by a number of investors. One other item here, there are some outstanding geopolitical threats. Ongoing issues include Russia and Ukraine, Israel and Hamas, and then China and Taiwan. These issues could lead to volatility in the markets, but they're very unpredictable. Therefore, it's difficult and typically not prudent to make investment decisions based on them. We'll continue to monitor as these situations evolve and things change, but ultimately, it's really, really hard to predict what's going to happen in situations like this. And so it's not advisable to make long-term portfolio decisions based on what happens with these geopolitical threats. Before we wrap up the presentation here, I do want to spend some time talking about taxes and tax policy. One of the big items that's really could affect every American truly is the 2025 sunset of the Tax Cuts and Jobs Act that was passed in the first Trump administration. When that was put into place, it was set to expire at the end of 2025. And at that time, everything will revert to the pre-2018 Tax Cuts and Jobs Act rates. As of recording, there hasn't been any legislation announced to extend the TCJA or replace it. So if nothing happens between now and the end of the year, we will sunset and move to these pre-2018 rates. You can see here the current 2025 rates and then a table that show the projected rates for 2026. Some of the key differences: the 12% bracket goes away and is replaced by a 15% bracket. The 22 and 24% brackets go away and are replaced by 25 and 28%. And then you can see that the top bracket moves from 37%, where it is currently, to a top bracket of 39.6%. These are some big changes that will certainly affect everybody. One thing that is important to note for retirement savers: capital gains taxes would remain either at 15 or 20% depending on income. So that is not set to change with the expiration of the TCJA. Still, whether the tax law will expire or what could replace it does create some uncertainty. I think the best way to look at this is to look at an actual example. So, if we look at how this could potentially affect a typical, U.S. citizen, consider a single worker who makes $65,000 per year and takes the standard deduction. The standard deduction for an individual in 2025 is $15,000. That would reduce her income to $50,000, which does lower the overall tax burden. We do have a progressive tax system in the United States, so a chunk of the income would be taxed at the 10% bracket, and then a large chunk would be taxed at the 12% bracket, while a small portion would be taxed in the 22% bracket. Overall, her total federal income tax liability under current law would be $5,914. Using the pre-TCJA tax rates and brackets, the standard deduction would be cut and would actually reduce to about $8,350. Personal exemptions would come back, making this taxpayer eligible for one of $5,300. Doing the math with the new brackets, her total tax liability would be $7,394, which is a tax hike of $1,480. This is a very simple example, and individual scenarios will vary, but most people can expect to pay more in federal income tax in 2026 and beyond if the Tax Cuts and Jobs Act is not extended. Certainly, everybody's situation is going to be different, but there's projections that roughly 65% of U.S. citizens would see an increase in their tax situation if we do revert back to those pre-2018 levels. There are a few other key items involved with the 2025 sunset. The gift and estate tax exemption would revert to pre-2018 levels. So the current exemptions for individuals, it's $13,990,000. And then for married couples, it's $27,980,000. So basically, for an individual, we're right at $14 million as an exemption. And then for married couples, we're double that, about $28 million. These are estimated to cut in half with the 2026 exemption. So it'd be $7 million per individual and then $14 million per couples. This is certainly a big change that could have massive implications on estate planning depending on an individual's net worth. There are a few other implications, some of which we talked about in the example. The standard deduction was doubled, so that would cut in half It would adjust for inflation, but it would come down significantly from where it's at currently. Personal exemptions were repealed previously, so those would come back for taxpayers. And the child tax credit was actually doubled as well, so the child tax credit could be reduced greatly. Itemized deductions were limited in the Tax Cuts and Jobs Act, so if it does expire, it's likely that more people will again be able to itemize. It is possible that the TCJA changes get extended or new ones get passed. Once the Trump administration won, it was widely speculated that there would be some sort of extension or new tax law passed with further cuts to taxes. This is going to be something to watch closely because so far we have not seen a new proposal announced. We do have one little quote here on taxes. I think this is a great quote. Tax reform is when you take taxes off things that have been taxed already and put taxes on things that haven't been taxed before. No matter what the reform or changes look like, or even if we do have the current law sunset, we know there's going to be tax that every U.S. citizen is going to have to pay. There's a few other tax policy proposals that have been talked about by the current administration, one of which is reducing the corporate tax rate from 21% to 15% for companies who make their products in the US. This kind of goes back to that America First agenda that we talked about on the first slide. It'll be interesting to see if that is just something that was communicated on the campaign trail or if that does get passed. They've also talked about increasing the deduction limit on state and local taxes, which are currently limited to $10,000. A couple of other key items that were discussed, especially on the campaign trail, were eliminating taxes on Social Security benefits and eliminating taxes on overtime pay and tips. It is to be determined if these are actually going to get passed, but we have seen some projections on what these changes could do to government revenues. The impact of this tax policy, specifically on the deficit, if we extended all expiring individual and estate tax cuts within the TCJA, and then along with those business tax changes we talked about, this would actually reduce projected government revenues by $4 trillion over 10 years, which is certainly a significant amount. The Tax Foundation has run an estimate, and they've estimated that Trump's aggressive tariffs could increase federal tax revenues by $3.8 trillion over 10 years, which would almost erase the impacts of the tax cuts. As far as end impact to the U.S. consumer, some of those tax cuts that they may experience could be offset with higher prices due to the tariffs. So we'll have to monitor that and see how things evolve over time. As we wrap up the presentation here, there are a few things that I want to highlight, one of which being that markets are resilient and innovation always wins. On this slide, you can see a number of innovations that have taken place since the 2008 election. A number of these have been around now for 10 plus years and are really a common part of everyday life. Things like cloud computing, tablets, rideshare apps, and electronic cars, I'm sure many of you utilize and see every single day. Recently, we've seen a lot about artificial intelligence in the news, and artificial intelligence is really still in its infancy. So there's a number of groundbreaking new innovations that are still yet to come, and companies are incentivized to continue to pursue these innovations in order to turn a profit. We do have a number of key takeaways that I'd like to run through really quickly. Number one being it's important to stick to your plan. It's important to remind yourself of your long-term goals and all the financial plan that you've set in place. Base your decision on your financial objectives rather than short-term political events. It's also important to stay diversified. This goes back to that asset class returns chart that we went over earlier. A well-diversified portfolio can help mitigate the impact of any single event or policy, including elections. Spread your investments across different asset classes, industries, and regions to reduce risk. It's also important to avoid emotional decisions. Knee-jerk reactions, based on short-term news, can be detrimental to a long-term financial plan. Going hand in hand with that, it's important to avoid market timing. We discussed that when we talked about volatility, but trying to time the market based on election results or policy is notoriously difficult and often leads to suboptimal outcomes. It's important to stay invested according to your plan rather than attempting to predict short-term market movements. Administrations last 4 years. Typically, a financial plan can be 30, 40, 50, even 60 years. So it's important to remember that time frame when you're making investment decisions. It's also really important to consider your risk tolerance, especially in times of heightened volatility. I think this is a great time for investors to take stock of where they're at and make sure that they do feel comfortable with their portfolio. If you find yourself becoming excessively emotional or anxious about market volatility, it may indicate that your portfolio's risk level is too high for your comfort. Certainly this is a great time to reach out to us, your advisors, and we can take a look at your financial plan and see if the amount of risk you're taking is necessary to meet your long-term goals. If it's making you uncomfortable and the plan tells us that we're able to reduce risk, we may be able to do that and still reach your long-term goals. Certainly, though, this is not a knee-jerk reaction, but something that we want to put a lot of analysis into before we make big objective and risk tolerance adjustments. Lastly, I think it's great to take a break if necessary. Turn off the news. It's certainly important to be an informed citizen, and especially to know how things are going to affect you, at the state and local level, especially. But if the constant barrage of political news is causing you undue stress, it's really, really good to take a step back. Make sure you're engaging in activities that help you stay relaxed and maintain perspective on the bigger picture. Like all things in life, it's important to have a balance between being well informed and also enjoying your day-to-day life and spending time with friends and family. That's it for our presentation today. Thank you so much for taking the time to watch this. Hopefully it covered a lot of things that you've seen in the news and maybe have had questions about. If you have any follow-up questions or things that you want to discuss in greater detail, please feel free to give one of our offices a call or reach out to your advisor. We'd love to discuss it with you further. As always, it's important to think about your individual long-term financial plan and not make decisions just based off things that you see in the news. Thank you so much for your time today. Make it a great day.